Discussion, which is a very pressing issue and has become increasingly evident and is impacting nations across the globe. Sustainability of the future is a major concern, and thus the evolving role of sustainable finance that needs to be dealt with a strategic approach. So, to explore how financial institutions can navigate the challenges faced and also lead the way in fostering a sustainable global economy, a few words about our guest speaker. Mr. Sunil T.S. Nair, Chief General Manager, Reserve Bank of India, is working in the Department of Regulation. RBI. He is a career banker with more than 3 decades of distinguished service in RBI. So I call upon Mr. Nair to kindly deliver the guest speech.
Shri Bishwaketan Das, CEO IIBF. Ladies and gentlemen, good afternoon to you all. I tried to keep you all awake. I know you had a very sumptuous lunch, so it's very difficult to keep awake, and more so the subject also is like you will feel sleepy, but I'll try my level best to keep you all awake. Firstly, I would like to thank IIBF for having invited me to speak on the topic of climate risk and sustainable finance challenges and opportunities. It's an honor and privilege to be addressing the gathering on this important and pertinent topic of the time. The timing of the topic for discussion is apt as COP29 is already in progress in Baku, Azerbaijan, where officials of various countries, including India, are putting their heads to solve the climate-related problem. The topics of discussion in Baku includes, among other things, about the funding requirements to meet the climate goals and targets. And it has relevance to the topic which has been flagged for discussion today. I would now like to share some of my thoughts on climate risk and sustainable finance. There are no two opinions on climate risk that it is and going forward would be a major risk for the financial system, economy, and society at large. Thus, climate change is here and we are experiencing it day in, day out in our lives. The recent spate of events, be it back-to-back hurricanes in USA, flooding in Spain, and closer home in Bengaluru, are a stark reminder of the climate-related threats facing the humanity. Climate risk is a challenge and an opportunity, and the financial sector has an important role to play in the entire scheme of things. It is in this context that a lot of agencies, be it standard-setting bodies, central banks, and other international bodies, are working on the aspect relating to climate change. India is a growing economy, and resources required for growth are huge, and added to it is a challenge of sustainable growth. Given this narrative, what would be the role of each of the agencies involved, be it the government, central bank, and other players, including banks? I would like to focus on the role of central banks in my address. As you are all aware, climate risk can be categorized as physical risk and transition risk. Physical risks result from both a gradual as well as abrupt impact of climate change and natural disasters on the value of real assets and financial instruments. Transition risks arise on account of transition effects, efforts of firms and economies to reach respective net zero, which can be disruptive. Climate risks impact the financial system through the traditional risk categories, be it increase in probability of default, loss given default, loan losses, rating downgrades, stranded assets. It's majorly expected to impact the credit risk of the borrowers and in turn have an impact on the banks and financial institutions. Other risks also matter, to name a few: market risk, liquidity risk, and operational risk. Given that India's financial sector faces both transition and physical risks, it is critical that banks and financial institutions identify and quantify this risk and integrate them into the existing risk management framework. Of course, by now everybody appreciates the fact that we have an understanding about the risks arising from climate change, but we have not yet reached a stage where we can state that we can comprehensively assess these risks, and it's a work in progress both nationally and internationally. One of the major limiting factor and concern raised in the area of climate risk is about availability of data. The Network for Greening of Financial System, NGFS, document final report on bridging data gaps highlights availability in terms of coverage, granularity, accessibility, reliability in terms of quality, auditability, and transparency, and comparability as issues in climate-related data. Presently, climate data is characterized by lack of uniform methodology, fragmentation in accessibility, lack of uniformity in publication of data, and difference in metrics, units, and formats. A thorough assessment of climate risk would require 3 sets of data. Number 1, historical loan loss data related to climate risk. Number 2, hazards data encompassing historical and future occurrences of climate events. And number 3, sectoral benchmarks for transition to net zero. Presently, there is no set practice among banks and financial institutions of labeling loan assets which have turned substandard or loss basis any climate risk event. This limits the availability of realistic loss data for integration of climate-related risks into the traditional risk management models to estimate probability of default. It also inhibits the banks and financial institutions from carrying out various simulations and scenario analysis exercises to arrive at realistic future loss estimations. Consequently, various approximation methods or data sets are being used to arrive at loan loss data and expected future losses. Talking about physical risk and particularly the hazard data, there is a need for India-specific data based on globally accepted range of scenarios. Having said so, scenarios provided by NGFS and Intergovernmental Panel for Climate Change's representative concentration pathways or the more recent shared socio-economic pathways serve as a good starting point to derive India-specific results. The outcomes arising from these scenarios can be run on global climate models to give global temperature outcomes, which can then be downscaled at a country level through regional country-specific climate models, which can then be used to inform on climate impacts like floods, drought, heat waves, etc. Thus, it is very clear that this is an iterative process with lots of inputs, but it is also a computationally intensive issue. There is also scope for subjectivity in terms of usage of inputs and models, which could lead to lack of comparability across the firms. Further, an added layer of complexity arises on account of vagaries of nature, namely areas which are dry are receiving rainfall, flash floods occurring in rain deficit areas. These developments limit usage of the past data for future forecasting. Coming to transition risk, there is a gap in terms of availability of sectoral transition benchmarks that can be used by banks and financial institutions to gauge the relative transition risk of the firms. Absence of taxonomy is again a constraint to determine which sectors need to transition and an indicative roadmap for the same. Further, the measurement of scope 1, 2, and 3 emissions are again at work in progress. But as we progress in this journey, these assessments would become more and more accurate. It is in this context that climate-related risk disclosures are very important. Not only does it motivate firms towards assessment of their own risks related to climate change, but also prepares the system at large to ward off any systemic issues going forward. The Reserve Bank of India intends to address the issue of gaps in climate data availability with the creation of the data repository, namely the Reserve Bank Climate Risk Information System, CRIS, which was announced by Governor on October 9, 2024. It comprises of 2 parts, First part will be a web-based directory listing various data sources, namely meteorological, geospatial, etc., which will be publicly accessible on the RBI website. The second part will be a data portal comprising of data sets, that is, processed data in standardized formats. The access to this data portal will be made available only to regulated entities in a phased manner. Another critical challenge in area of climate risk is on building a robust assurance function. Given the importance of data for correct assessment of climate risks, it is imperative that data submitted and used by firms, banks and financial institutions are true and verified. Further, as climate data is slightly different from accounting data, these require specific knowledge and expertise. Development of a robust ecosystem for mitigation of climate risks and providing an enabling environment for development of assurance functions also requires an interregulatory coordination. Climate change mitigation would mean financing opportunities for green and sustainable projects and technologies. India has committed to the COP26 its Panchamrit goals, the nationally determined contributions. It includes to reach 500 gigawatt non-fossil fuel energy capacity by 2030, 50% of its energy requirements from renewable energy by 2030, reduction of total projected carbon emissions by 1 million tons from now to 2030, reduction of carbon intensity of the economy by 45% by 2030 over 2005 levels, and achieving the target of net zero by 2070. These targets create enormous opportunities in solar, wind, and other renewable energy projects, including construction of energy efficient buildings and climate resilient infrastructure. There is also a growing trend of adoption of electric vehicles for transportation, battery storage systems, waste management, which presents a broader set of opportunities for climate finance. Having said so, challenges remain. The first and foremost is the inherent riskiness of the green or sustainable projects, as they are based on relatively new technologies which are yet to stabilize and streamline. Hence, assessment of financial and techno-economic viability of the projects becomes challenging. This leads to an inherent greater credit risk as compared to traditional financing, which is more stabilized and predictable. Any sustainable lending project may be classified as either bankable, partially bankable, or non-bankable. The partially bankable or non-bankable projects require support in form of incentives such as grants, guarantees, etc., for them to be viable. The partially bankable projects are also essence of blended finance, wherein the public-private partnership is fostered to bring in finance for sustainable projects. For non-bankable projects, adaptation finance has been used as a means to fund the same. To address climate-related financial risk, it is also essential to develop and enhance the capacity for climate scenarios and risk analysis among policymakers, regulators, firms, banks and FIs, and private sector stakeholders, as also facilitate open discussions on related issues. Capacity building requires a holistic approach, which would mean building capacity and creating awareness right from the board to senior management to the desk officials to assess and mitigate the risks. Climate risk is a technical area requiring specific skill sets, and there is a need for staff as well as management to be well versed in concepts related to the climate risk. This will require more intensive and hands-on training, and still a lot more work needs to be done. I think institutions like IIBF are doing great work in this area by facilitating capacity development and organizing such discussions for exchange and free flow of ideas. Tackling problems of climate risk would require a collaborative effort from all sections of the financial ecosystem as well as private and public institutions. It is a problem which is going to affect all of us, and a holistic approach is always better than sum of parts approach. So I look forward to the academia and firms coming together and specifically building and training capacities for assessment and mitigation of climate change. To conclude, some food for thought. What are the minimum requirements that are required to be put in place by banks and FIs as they embark on this journey of climate risk mitigation? What will be the role of board, senior management, risk management, and internal controls, etc.? Number 2, India has a net zero target of 2070. NGFS scenarios are designed keeping 2050 net zero in mind. Do we need to develop India-specific scenarios? Number 3, what is the preparedness of banks as far as disclosure requirements are concerned? For those of you who are aware, we came out with the draft guidelines. We'll be coming out with the final thing. So how are the banks and FIs going about addressing this challenge? Number 4, do banks have adequate resources or manpower in this area, or are they working in this direction? Number 5, data-related challenges. Is there a need for data to be housed at a single place so that it can be sourced by all regulated entities? Of course, RBI has come out with an announcement that will be coming out a data directory, so that solves the problem. Number 6, absence of taxonomy and transition pathways for sectors. Number 7, and last, are banks and financial institutions talking to their corporates in terms of their transition plans, and if so, what is their funding requirement so that they can transition to net zero? I'll stop here. Thank you.
Thank you, sir. I now request our CEO to kindly hand over the memento to Mr. Nair.
Thank you, sir, for sharing the perspective from the regulatory side. In fact, in India, RBI has done quite a lot of things to facilitate this sustainable finance in the banking and financial institution, including the green bonds. Thank you, sir, for sharing with us.